Hey, you've got Tom, Gail, and Terry coming in.
Perfect, perfect.
And you're live on Facebook.
Thank you. Let me get it up on my phone so I can monitor the whatchamacallits. All right, all right. Got some people jumping on right now. That's good. Just a second. We'll get rolling here. All right, all right. Got some people jumping on right now. That's good. I got to shut the volume off on my Facebook Live. Yeah. Thank you. Thank you. All right, so guys, we got a lot of stuff to cover today. And so I hope you've got your pen and paper and everything that you're going to need. Because Tactic 10, let me ask you this. Has anybody gone in and looked at Tactic 10 and read up on it, on what we're about to go over today? It's expand the options, and it's focused on creative financing. So you guys are going to get some numbers today, okay? And I don't want you to be bogged down by that, but just to kind of show a little bit of a different reality around numbers and financing in a shifting market. Anybody look at this last night or review it? Okay.
Sure.
No worries. All right. So what we're talking about is creative financing. So when we move into a shifting market, so who can tell me right now what is happening inside of our market around finances, around lending, let's just say specifically. So what are rates doing right now, guys? They're going up, they're going down, they staying the same. What are you guys seeing? What's that, Chelsea? You can unmute yourself. Chelsea says they're going down. Terry says it's kind of mediocre, right?
Yeah,
What's that,
I
Chelsea?
think it's still depending upon credit scores and such.
Okay. We haven't seen a huge jump up or a huge jump down. We've seen a fluctuation in the 3 and 4% range, right? Now, guys, listen, if you're not having the conversations, make sure you are talking to your lenders. Tell me what's going on, what's new. Right now, what some banks are doing is banks are tightening their guidelines. They're tightening their guidelines around the credit scores, Terry just said. So, when we talk about, hey, you need to have, and if you guys don't know this, just a kind of little crash course 101 in the lending side of things is certain banks or certain lenders will loan to a certain credit score. They will not go below that typically. And so where some of the bigger banks can take bigger risks, they can loan to lower credit scores. A lot of credit unions will do this. So a lot of them have started to get tighter on that. What that means is you got to have a better credit score to qualify for that loan. So that's number one. Number two is down payment assistance is going to be really hard to find right now if you can find it. And it's going to probably become non-existent for the next couple of months. Let me just explain why that is, okay? What's going on with down payment assistance right now is you can get up to, let's say, $8,000 down payment assistance. Yet I've got a great job right now. I work for an attorney. I'm a paralegal. I'm salaried. Blah, 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 blah. 30 days down the road, 40 days down the road. I'm under contract on my house. Chelsea's helping me buy a house. I'm under contract, but I'm not going to close for 50 days. And about 30 days down the road, I get furloughed or I get laid off. Yet I was using down payment assistance because of my job. I didn't make enough of a salary, so I was able to qualify and get my $8,000. So I'm still qualified to go ahead and close on this property. Yet now down payment assistance says, instead of taking it from the beginning, now I don't have a job anymore. Down payment assistance says we're not going to pay anymore. So then what happens? So the lender's got to do one of two things. Either they can still push the loan through because I qualify, and the lender has to eat the $8,000, which, let's face it, they're not going to do. or they're going to terminate the loan. And they're just going to say financing no longer works out unless I can go get a gift or unless I can come up with that $8,000 in a different way, shape, or form. So a lot of companies right now, guys, a lot of lenders that are out there have said, nope, we're not going to do any assistance on down payment assistance programs. They're just not going to offer them right now because it's too risky for them. So how do we get creative with our buyers when we're getting limited? You got to have better credit scores. Assistance programs are pretty much gone. So let's look and focus on the 3 areas of creative financing. If you're following me, you were right on page 200 in the shift book. Okay. Number 1. So there's 3 ways that we can get creative. Number 1, creative things sellers can do to sell the property. Number 2, creative things that buyers can do to purchase the home. And then number 3, creative things lenders can do in the financing. Creative things lenders can do to finance a transaction. So let's just look at them real quick. There's 3 categories with 8 points. So number 1, what can a seller do to sell their property? Seller contributions, right? As long as it's still going to go and fall inside of that appraisal rate, I'm going to sell my house for $270,000. Yet I'm going to give seller contributions of $5,000. So what I'm going to do is I'm going to list at $275,000, and as the seller, I'm going to put in the listing documents that I'm giving $5,000 in closing costs, or up to $5,000 in closing costs. So that's how sellers can be proactive. Seller-funded permanent buy downs. Seller can help assist with the buy downs of a property. They can't give cash to the buyer across the table, but can help out with some of the buy downs. Seller-funded temporary buy down, so permanent or temporary. Owner financing. You guys, this is something that we really don't see a whole lot in our business, yet it is an option that's out there where maybe the seller is in a situation where they're comfortable enough that they can carry the note on the property and the buyer then pays the seller directly, right? And they'll have a contract written up by attorney and so on and so forth. So it's all done on the up and up. There's also something in here that they don't talk about in the book, but aside from seller financing, what about loan assumptions? Okay. Now, guys, this is something that the loan already has to be assumable at that point in time. And for a buyer such as myself to assume the loan on Terry's house, let's just say, for example, right? Terry has it worked out with Wells Fargo. That's his bank. They hold the note, this, that, and the other thing. Well, it's not up to Terry if I can assume his loan. Yet, let's just say, for example, I've got bad credit right now. So I'm going to go out and I'm going to be paying, 4.75 on an interest rate. Yet Terry's got phenomenal credit and he locked that bad boy in at 3.25. Now I want that interest rate, right? I mean, I'm going to save myself on average probably over $100,000, $120,000 over the life of the loan if I can get that lower interest rate. So what am I going to do? Maybe that $300,000 house that you have, Terry, I'm willing to go ahead and pay $310,000, $315,000 for. And as a result, the seller could get more money, yet I'm going to assume his loan and I've got the cash that I can pay him the dividend or do another type of seller financing with Terry on the side when I assume his loan. Now, Terry has no control over if I can assume his loan or not. That's going to be up to the bank, okay? So if it's Wells Fargo, for example, they would say, okay, we need you to see this credit score, so on and so forth. Does that make sense, guys? So that's just another way in part of the owner financing or seller financing. The contract for deed, same type of thing. Just, hey, we're going to put in place this. Think of like a lease purchase, right? So let's say I'm going to buy that house from Terry, and Terry says, okay, this is what we're going to do. You're going to pay me $1,500 a month. Awesome. $500 of that is going to go to Terry because he's still holding the note. And every month I get credited $1,000, $1,000, $1,000. Okay. This is called creative financing, guys. The only thing I can promise you is that you can kind of cut this any way you want because it's legal for us to manipulate the contracts in a way that's going to make it work and get it across the table. If you're doing any of this, guys, any of this stuff, you better have an attorney writing all of this, okay? I don't want to see anybody writing any of their forms. Terry's our compliance guy. Rob's our broker in charge. I will tell them to say, no, that deal does not work. We want to make sure you're protected, number one, as an agent. More importantly, we want to make sure your clients are protected in this as well. I've done lease purchases before with McNaught's office, and they have sat down and written this out for me. So it's always good to think outside the box. Let's just make sure we have the proper legal parameters in our back pocket so it's done the right way. Sellers can take a second on the home. Lease option, lease purchase, we just talked about, and then wrap around on the assumable mortgages. So those are all of the 8 things that are put out there that sellers can do to get a little bit more creative on the financing. Okay, now let's move to the buyers. What can the buyers do to get creative on their financing? Has anybody ever gotten a gift when buying a house? Yes, no? I have. First house I ever bought, my parents gifted me $8,000. It was great. Okay? Those are gifts. Those are not to be paid back. My parents are old school. I got to pay it back. So, but those, you can get gifts. Becca Mangini, you are 100% correct. Assume a mortgage, page 209. Becca, thank you so much for reading ahead. I appreciate that. So gift funding, selling and refinancing existing assets, right? What could we have as an additional asset? Maybe you've got an extra vehicle, right? Or maybe you have a second property, and maybe this is your main property you're selling, you're moving into a new one, and maybe you can refinance that mountain property and help get some more cash in your hand. Cash out refis, right? Non-occupant co-borrowers. I've worked with some younger first-time home buyers that do this, where mom or dad will go ahead and they will be a non-occupant co-borrower. They do not have to be on the deed. They do have to be on the mortgage, though. Using a 401k. If somebody does have a 401k, temporary IRA, Roth 401ks, Roth IRAs. If you guys don't know what I'm talking about, it's a conversation for a financial advisor if they have it. One other thing in here too that they don't speak to, but while we're on the topic of IRAs and 401ks, is what's called a portfolio loan. I myself, I have 2 different life insurance policies, okay? And what I do is I contribute X amount of dollars into my life insurance policies on a monthly basis. As a result, I'm able to, if I need to, go ahead and dip into some of that money. Just FYI. Portfolio loans will take somebody's entire portfolio, and there's certain banks that will loan on portfolios. So for example, I know South State Bank will loan on portfolios. So let's say that Tom has approximately a value of $10,000 in what he's doing on the stock market right now. And he's got another property, and maybe Tom has some artwork that's very high end, that's insured through a portfolio. That stuff can all be used as collateral. Now you got to check with the bank to see if they will accept that, yet the bank can use that as collateral for a loan. Does that make sense? So portfolio loans, we want to look into that as well. These are all the questions you guys need to be asking, because we don't know what they have and what they don't have. All right, pledged asset mortgage, just talked about that. Equity transfer, equity transfer, right? Or what's also known as a bridge loan, right? I'm not going to give you guys a whole lesson, because first of all, I'd be wrong in what I'm saying, because every company does bridge loans differently, okay? There are some other short-term ARM loans, right? You guys have heard of an ARM before. A lot of times when I talk to real estate agents and they've heard of an ARM loan, what they're saying is, I was told never do an ARM. Okay, well, okay, it's a loan, so it works for somebody. So let's talk about it for a second. An ARM is an adjustable rate mortgage. What an adjustable rate mortgage means is today, right now, it's at this rate. And the rate tends to be a lot less, maybe not a lot less, it tends to be less than what the prime is going in. So I know that if I get a 2, a 3, a 5, or a 7-year ARM, okay, those are the most common. And so as a result, I go ahead and I know that I'm only going to be staying in, let's say I'm a transfer in, right? Katrina, our productivity coach, she did a lot of military where they were going to be stationed there for 2 years or something like that, right? Well, if I know I'm going to be stationed there for only 2 years, I take out a 3-year ARM, I get a lower interest rate, and as a result, then I'm going to be selling it before the 3rd year's up anyways, and I'm not going to have to go to the adjusted part of the rate. The other thing is this is good for people that are very cash heavy, or maybe they have that cash in a 401k and they go on, let's say it's going to be their permanent home. I'm going to go on a 7-year ARM, okay? My loan amount's only going to be $150,000 on the $300,000 home, so I can put a lot down and I'll be able to pay it off within the 7 years before the rate jumps up. If they can do that, those are great options. However, what got people in trouble, and this is something my father has always told me since I was a little kid, is you can't live beyond your means. And a lot of people said, well, I see a lower interest rate there, so I'm going to get a 7-year ARM. I have no plan or way to pay it off. And then what ends up happening is when year 8 hits, instead of me being still locked at this 2.75 interest rate, which is phenomenal, now it's 7%. Now it's 6.5%, whatever it could jump to. As a result, I'm in trouble now because my payment just jumped by $400 a month and I can't afford to do that. So you got to make sure, because then it comes to a situation where now I'm forced to sell. And now maybe I have to take lower amount because I have to sell it because I didn't properly understand how an ARM works. I'm not trying to turn you guys into lending professionals. Let me make that very clear. Whoever is giving them the loan needs to be educating them on this stuff. You guys have to have an understanding of it, though. Okay. All right. Equity transfer, bridge loans, employer assisted mortgage. Has anybody ever heard of an employer assisted mortgage? A lot of times we've got people that work in our world. So for example, real estate agents are a perfect example. If you've got a part-time administrative assistant, they're never going to be able to qualify for a loan being part-time, so on and so forth, unless there's somebody else on it with them. So could a company go ahead and assist with the mortgage, or could you as a real estate agent assist with the mortgage for that person, where either you're silent sign-on, what have you, right? These are all different options that we could do. And even inside bigger companies, guys, we see it all the time with MetLife, Chiquita Banana, Arriva, all these companies that have come here, Honeywell now, Truist, the new bank, right? They're doing assisted mortgage a little bit differently. Instead of the company taking on like a co-signer, the company is saying, hey, Tom, I'm going to sell your house there, okay? So just go ahead and give me the house, and we're going to sell it for you, and we're going to go ahead and give you X amount of dollars for the house. We agree upon the value. Tom takes the deal of $235,000, and I say, congratulations, buddy. We're going to give you a $50,000 moving bonus. So as a result, now that is a different form of employer assistance, yet it happens all the time right now. Okay, creative things lenders can do to finance a transaction. So talk to your favorite lender, right? See what they're willing to do. Guys, this is a great opportunity for you to get with your allied resources. I see Gail on here. Gail and I were talking earlier this morning about her favorite lender and how well he takes care of the people and everything. And so, hey, what are you guys doing right now to get creative with your financing so we can still get butts into homes, right? So lender-funded buy-downs, right? Can lenders do a buy-down? Absolutely. If you guys haven't used Keller Mortgage yet and pinned it up against another lender, watch them do a buy-down real fast, okay? Movement Mortgage will yell at me for this. They will go ahead and waive their $1,000 application fee right away if they know that they're going against Keller Mortgage. Use it to your advantage, guys, because after all, I'm not calling out Movement Mortgage, I'm not calling out any of the other lenders out there, but typically they will all drop their application fees right away because they know they can't compete. And the point is, you guys took an oath. You have a fiduciary duty and responsibility to your clients and your client alone, not to your mortgage lender, okay? And don't everybody go run into all the lenders now and have them calling and blowing my phone up, all right? Just giving you guys some advantages. Fannie Mae. Fannie Mae, Freddie Mac. Penny Mac's not really doing the loan side of things anymore, but Fannie and Freddie, and now what's called New Res, which is kind of taken over for Freddie, they've got different loan assistant programs if you go directly to the horse's mouth. If you're using Movement, if you're using Fairway, if you're using Summit, if you're using any of these other lending companies out there, understand that those loan officers are kind of like a broker in between, and they're getting the loan. FHA loan, they're getting from Fannie, right? Go straight to the horse's mouth and talk to Fannie yourself, okay? Running scenarios with automated underwriting systems, okay? So kind of what we were talking about before when it comes to the down payment assistance programs. I know Movement, and I'll give Movement kudos here as well, because they do what's called a pre-approval TBD, right? A pre-approval to be determined, so that basically that person's already through a full pre-approval process. That'll definitely help out. Adjusting amortization period to lower a payment, okay? So what are the two amortization periods that we guys see most commonly? Two numbers, right? How many years?
30 or 15 and 30.
30 and 15, I hear, right? Yep, those are the two most common. So Terry, you guys, and Tom, you guys are correct. Would a bank do a 40-year amortization? I don't know. Right now, probably not. Yet, if we ask the question, if it gets that bad, they may have to go to do something like that, right? Now, that may get a little bit riskier for them over time, which is probably what's going to keep the interest rates low right now, or keep them there and about where they're at, okay? All right, next. Adjusting interest rates to cover closing costs, okay? So you guys have heard of a buy down on interest rates, right? You guys heard of this before? You can go ahead and purchase down, okay? Can I tell you guys a secret about foreclosures real quick? No? You don't want to know the secret? Oh, okay. All right. Okay, good. Just making sure you're all awake. Okay. So here's a secret for you about foreclosures. Do you know that when you get into, and you guys know I have a lot of experience with this house right here is a foreclosure that I live in now, okay? When you go and negotiate a deal, there's not a whole lot of negotiation that goes on. Typically, you do a lot of your negotiation before you even go under contract. Once you do get under contract, or you guys have agreed upon a number, what they're going to do is they're going to come back with this number. And so a couple of different tricks that I've done with foreclosures in the past. Number one, I start every single one off as an FHA loan no matter what. Why do I do that? Because Fair Housing Administration has different requirements, meaning if there is a crack in a window, that has to be replaced. And if it's going to impede the loan from going through, then they're going to have to replace it. If the water heater's not working, if the furnace is not working, they have to go ahead and facilitate a repair on it if it's FHA. If it's conventional, they don't have to. So that's your first little tidbit. Second thing is we agree upon a price. We get that price and we're going to sign. We haven't signed yet, but we've agreed upon a price. Ask for 3% in closing costs, okay? The way Fannie Mae and Freddie Mac work is they have an algorithm that works out to a certain number that they have to hit. What everybody doesn't know is they've already factored in for 3% of closing costs. So, Tom, you don't need closing costs. That's great. Ask for it anyways, and I'll show you how to use it. When I bought this house, it was $305,000 is the number that we agreed upon. Okay, I told them, I said, okay, and I'm going to need closing costs if I'm going to pay that amount, because I know that they'll pay up to 3%. So what's 3% on $305,000? That's right. It is $9,150. Now, my closing costs for this property were just over $6,000. True story, guys. So what did I do? I went back to my lender and I said, okay, how much is it to buy a point? Now, it cost me $6,000 and change to buy a point. Yet, I was able to reduce it down by an eighth, number one. Okay. Now, by reducing that by an eighth of a point on a $300,000 property, that was roughly going to save me $50 a month. Okay. At $50 a month, I was saving about $18,000 over the life of the loan on a 30-year fixed with 360 payments. So I'm saving 18 grand by coming out of pocket only $3,000 because I had the 9150 already paid in the closing costs. So when you're talking with a foreclosure with a Fannie or a Freddie, they always factor in a percentage for closing costs. It's up to 3%. Now, if it's a foreclosure with a bank, it may be a different percentage. They may negotiate with you a little bit more, yet you will always get the 3% from Fannie or Freddie or what's now called New Res. Okay, so guys, just tuck that away and be mindful of that for yourself moving forward. Now, on the flip side of this coin, what else could we do? We could maybe increase that percent. So I've got no cash right now. I'm broke as a joke, and I'm going to lock in at 3.625. And I go to my lender and I say, Terry, how do I get more money in my pocket, yet I can pay it over time? Well, Terry says, well, what we'll do is instead of buying down a point, we'll increase by a point. We'll go to 3.75. And as a result, now the loan could be more affordable for me right now because I'm cash light, right? Or Terry and Tom both told us 15 and 30-year mortgages. You could do a 20-year mortgage. They're not as common, but you could do something like that. So if you're looking at a 15, extend it out. Now, as Terry already told us, probably not really going to get anything over 30, not at least right now, maybe in the future. I doubt that 'cause it's a very long time. And let's face it, the banks are in the business of making money off of what they lend out, off of the interest. There are different loans that you can do that are very interest forward. You guys go and get a typical conventional loan right now, and these are just ballpark numbers. Don't quote me. Again, talk to your lender. About 20% of what you're paying can be going right off the bat. About 20% of what you're paying is going to be going towards your principal, towards equity in your pocket. What if they were getting more of their interest-only loans up front, right? Could you get a better rate over that? Now, you're not building any equity in the house or very little equity in the house, maybe 5 or 10%, yet it's another option. Again, it's how the banks or the lenders can be creative around this. State, province, and local grant and bond programs. Well, we just talked about some of the down payment assistance programs that are kind of going away. Yet there could be bond and grant programs. You would have to look into that according to the state. Who's heard of a Good Neighbor Next Door? Has anybody heard of this? See Terry nodding? Yep, Tom. Okay. Good Neighbor Next Door is for people that do service to the industry. So, for example, your EMTs, your firefighters, your nurses, police officers, teachers, state employees. They all do a service for the community. Now, this loan works a little bit differently. They have selected these houses that are qualified for the loan. So you can't just take this loan and use it on any house, yet it can be used on the selected properties. The good thing about this loan is Uncle Sam pays 50 cents on the dollar. One of the very first deals I ever did was Good Neighbor Next Door, and I learned a lot. Yet I had a friend that was able to buy a property in Myers Park. Actually, it's Madison Park area of Myers Park and South Park for $92,000. And we were able to then go ahead and sell it about 5 years later for about $225,000. So he did very, very well. And there are requirements on how long you have to live in the property and all that. I'm not going to go into the details. Talk to your lender. Yet there are programs out there from local, state, and county governments. Mortgage credit certificate. Again, talk to your lender about a mortgage credit certificate that can be paid almost like a second. And then, of course, private lending, right? Tom's a big wig. He's got a ton of money. So he's going to go ahead and he's going to lend me the money, and we work out another deal just as if it was like a seller financing, yet he doesn't own the property. He'll take over the note on the property, and then he'll sign a quitclaim deed when I've worked out whatever agreement I need to work out with him. All right, so we've gone over these, and again, I'm on page 200 right now in the shift book, creative things that sellers, buyers, and lenders can do to help with the financing. And this is the thing, guys. If you're dealing with a lender who doesn't want to do any of these things, or if you're dealing with a listing agent that doesn't want to do any of these things, okay? They're just being lazy. You guys need to understand that everybody in this wins because we all get paid. All right. And so what sometimes we need to do is we may need to educate that lender. Okay. We may need to talk to their supervisor. Sometimes we may need to educate that listing agent. Right. And so, guys, we need to do it in the appropriate manner and be polite about it. And as a result, we can go ahead and then move forward with getting the deal done. And that's what it comes down to. So, so we talked about the things that sellers can do. So I'm going to give you a quick little breakdown, and this is on page 203 if you're following along in your book, of what a seller contribution versus a seller price reduction can do. Okay, so for example, if the property sales price is $250,000, pay $5,000 of the closing costs at a 5% conventional down payment amount. That's $12,500. $0 in closing costs. Total out of pocket for the buyer, $12,500. Net to the seller, $245,000. And then there's the loan amount of $237,500, and the monthly payment for the buyer will be $1,501. Now let's just look at it if they did a price reduction, okay? So the price reduction is just to $245,000. There's no seller paid closing costs. So now $245,000 is the sales price. Down payment is still the 5% at $12,250. So it's $250 less on the down payment amount. And then the closing costs are $5,000 where they were no closing costs before. So now the total out of pocket moves from $12,500 to $17,250, which the seller may or may not be able to pay. The net to the seller is still the same. They still make $245 minus, their expenses or mortgage or whatever. And then the loan amount now is a little bit less. It's $232,750, and the monthly payment is $1,471. So for really what we're talking about is a difference of $30 a month in a mortgage payment. Yet with the seller paying closing costs, as a buyer, I'm paying an extra $30 a month. Yet I'm saving myself just shy of $5,000, $4,750 that I may not be able to come out of pocket with right now. Okay, so if you guys want to look at that, that's on page 203. It's just a breakdown of the difference whether the seller is paying the closing costs or they're reducing the price on the home. If the buyer has the money, by all means, go right ahead and do it. I think we're going to see less and less of that coming up right now. There's a couple of other scenarios in here with seller seconds. I'm not going to go through all of these in detail. Please, guys, go ahead and read this, okay? Now, when we're talking about the buyer getting creative, okay, we've got to look at the three categories for a buyer. So does anybody know what the three categories are that work in a buyer's favor? Maybe I'm not saying it the right way, but when you're getting a loan, what are they going to look at? They're going to look at, number one, what?
Employment.
Okay, I heard Chelsea say credit. Yes, credit's one. What'd you say, Terry?
Employment history.
Employment or income, right? So credit, income. And there's one other thing they're actually going to look at. Assets. Okay, they're going to look at assets that you have. You guys have probably commonly heard this referred to as DTI, okay, debt to income ratio, meaning what do you own right now? Well, if you own it outright, they don't care, and it's still an asset. Yet they typically don't even think about it if it's owned outright because it's one less thing that a lender has to worry about. Yet that asset has a value to it. That mint condition 1965, Shelby GT Cobra, that has a value to it, and can it be used as collateral? Most lenders will say no, yet however, this is where you have to get creative. So when you guys are talking to your buyers, you want to ask them, okay, what they're going to do is they're going to be looking at your credit and your income. Now, you don't need to know those amounts. Your loan officer needs to know those amounts. However, a loan officer is not going to ask them about their assets. So you may want to go ahead and ask them about any additional assets that could be used as collateral on a purchase. And then the challenge is just finding somebody that will do something like that, right? Finding somebody that will approve the loan for that. All right. You talk about monthly payments, right? And so based on the interest rate and percentage, now guys, forgive the math on this because obviously this is a little bit older, but on monthly interest rates, right? On a 30-year fixed for a $180,000 home, if the payments are at 6.5% interest, and I know we're a lot lower than that right now, that's $1,137. That's $13,644 over a year. Now, if that's down at 5.5%, that's $1,022 or $12,264 over 1 year. Lastly, if it's at 4.5%, that's $912 or that's $10,944 over 1 year. So when we're looking at the amounts and what we need to have paid in, right? That's your total mortgage right there. Well, let's think about it. Chelsea, you're buying a house with me and you qualify for all this, yet if I can move your interest rate from 4.5 to 5.5, and the interest rates are low in these numbers right now, this is not an unusual scenario, yet Chelsea, you'd be paying $912 in a mortgage right now. Could you afford to pay $1,022 in a mortgage? An extra $110? Could you afford to do that? Sure. Okay. Then the option may be to go up in the interest rate so that as a result, we can get more upfront cash, however, to rework the loan. Does that make sense, guys? I feel like I'm not saying it the right way. Okay. Good. Thank you. All right. The other thing is you guys may want to look into, and it doesn't talk about this in the book, yet just from my past experiences, you may want to look into some other creative finance methods that are out there. So number one, if you guys don't have a CPA, get one. Have a conversation with the CPA right now. If you guys don't have a financial advisor, start having a conversation with a financial advisor right now. There are a lot of other companies out there that will go ahead and help with the financing of properties. There's a company called Shakespeare Investments. I use them a lot when I'm dealing with short sales. Not so much when I work with the foreclosure side, yet they take care of all the legal parameters of the paperwork and everything that we can go ahead and get the property sold, facilitated that way. So guys, there's lots and lots and lots of different options that are out there. We just have to dig and find out what is going to work. Now, what we're going to see is the conversations that we're going to be having with lenders right now. They're not there yet, guys. This is going to be, we're shifting ahead, right? We look ahead, we don't look behind. These are things that are going to come to fruition in the next 2 or 3 months, okay? If everything starts turning that direction, stop sticking your head in the sand and saying, oh my God, the sky is falling, right? Let's say, okay, so there's as Gary Keller says in this book, I think it's 42 or 43, there's a gift and a shift. There's always a gift and a shift. So what happens if Cece's my buyer, she comes to me and I'm like, nope, lender won't do anything. She goes to Tom, Tom's like, nope, lender won't do anything. She goes to Chelsea and Chelsea's like, I've got these options and let's go talk to these people and see what we can get done. Who's going to get the deal and who's going to get paid? Chelsea, right? So we've got to be open-minded and we've got to understand that maybe some of the answers that we're getting from creative financing with lenders right now, maybe those answers are going to change in a month or two. What I would do if I were you guys is I would go ahead and just have a conversation with your favorite lender right now and saying, worst case scenario, here's 8 examples of different things that lenders can be doing in order to get creative with the financing. Which one is your company doing? Or which ones are your company doing? And they're probably going to go, I don't know. Oh, well, you know what? Maybe that opens up dialogue for a conversation. The sooner you guys can start that conversation with your favorite lender right now, the sooner they're going to run it up the flagpole, the sooner that company's going to take action. And this is how you guys, you're all in sales, right? Do you want to be the only lending company right now that, or in the next 2 to 3 months, that's selling houses? Because this is how you do it. Guys, give them a copy of this book, okay? And go through it with them. It will really help, I promise, even if you have to do it via Zoom. All right, so that is tactic 10. What questions, comments, concerns, what do you guys got around that? I know I gave you a lot of stuff. Nothing? I did it perfect? Awesome. I knew this was a long chapter, and I know we've already gone over, so I'm going to let you guys go. Be back tomorrow. We will have a special guest on tomorrow, so come back tomorrow, 2 p.m. Pivot with PJ. And guys, just keep doing what you're doing. Wait, and let me, before we leave, was anybody on the 11:30 Thrive call today? Was anybody on that?
No.
Okay, it's in the daily update. It'll be going out again today with the daily update. Guys, check in on that. It was pretty amazing. Mark Brenneman, our regional director, was asking questions of agents, and every agent he came to that he was talking with, he said, "Hey, just tell me something good." And they were like, "Just closed a deal and put another one under contract. Just got a new listing." One person who just put one under contract and has a listing appointment for later today. Business is still moving. And what was funny is a lot of those people that were answering were in Mecklenburg County. And they're figuring out creative ways to go ahead and do Zoom seller presentation. And the only reason I know that so well is because one of the people on my team was one of the people that has an upcoming listing appointment, and she's doing it all Zoom. And the people are just beyond words excited about it. One thing else I'm noticing, and our leadership talked about this morning, is that we as a leadership team are seeing how people are reacting. And one of the things that we're seeing right now, the feedback that we've been getting because of all the calls we've been making to you guys, all the calls we've been making to clients, is that people are kind of over this thing right now. And they're ready to just, let's get back to a new normal. I had a guy call me this morning who was a past client from 7 years ago. Okay. It was the 8th deal I ever did in real estate. I looked it up. Okay. And he called me up and he said, "I see a great advantage right now in this market." And he said, "Look at this house. What do you think?" And I was like, "Well, it's $319,000. It needs a ton of work, but there's nothing else in the neighborhood less than $460,000. I said, "Yeah, that's a good deal." And so he's like, "All right, I got to figure out how to sell this house and get over there." And so we're working that right now. Again, there's a gift and a shift. So look for it, guys. And make sure that you guys are not the ones shooting down and just saying, "Nope, I know that's not going to work." If that's your mentality, you got the wrong mentality. Change your mindset. Go and ask questions. Okay? Guys, make it a great day. Thank you so much. Let's have a kick butt week, and I'll talk to you guys soon. Have a good one.
Thank you, Jack.